Morning, everyone. Hi, my name's Stephan Linder. I am not related to Ed Fenster, though I get that a lot. And actually, walking out of Ed's keynote, somebody told me, great presentation, which I really appreciated, but I guess we have to wear different jackets next time. But my name's Stephan Linder. I run Sunrun's integrated financial product and pricing. And I also spend a lot of my time doing market intelligence at Sunrun, assessing the market landscape and making sure that Sunrun products and our pricing is in the most competitive positioning possible. The goal of this is to talk over what's in store for 2016. It's been a very exciting few weeks in residential solar with the ITC extension, California NEM 2.0, with everything that's going on in Nevada. A lot of things are changing, but makes for an exciting time. So I'm going to start by going over the top 5 things to expect in 2016. I'm not as creative as David Letterman, so I went with 5 instead of 10. But start out with number 1, far and away, ITC extension is bringing a lot of certainty into the market. This is huge, both from a business planning perspective, a capital markets and stock market perspective for public companies like Sunrun and some of our public competitors is frankly massive. In terms of the scale of it, in the residential solar industry, this creates about 6 gigawatts of new capacity, about 1 million new residential solar systems, which is huge, and about $15 billion in total investment. Number 2, utilities are doubling down to battle net metering. We will be up for the fight, though. I'm sure many of you are familiar with what's going on in Nevada lately. We expect to fight that. We expect to win and overturn the ruling there. But utilities, especially with the ITC extension, are only going to be doubling down. It's going to be a catalyst from our side in terms of deployment, but also from their side in terms of investing resources to stop solar. But that said, we're up for the fight. Number 3, cost structures are going to fall. So if you listen to Ed's keynote, one of the goals on our side as a company is to reduce our cost structure. If you have listened to some of SolarCity's latest earnings calls and their analyst day, this is a key area of focus for them. They are aiming for, in 2017, a average blended cost per watt of $225. That's fully wrapped, so including installation, sales, and all the overhead on a dollar per watt basis. The industry is focusing on cost structure. Sunrun's focusing on cost structure. It's a time in this industry where growth is de-ramping from that extremely crazy pace that we've had for the past few years, and that leads me to trend number 4. Major players are going to be focusing on smart growth rather than call it growth at any cost. So companies like Sunrun, companies like SolarCity have been focusing on 60, 70, 80, up to 100% year-on-year annual growth, as well as some other smaller and mid-sized partners and installers in the space. We've reached a point in the industry where things have matured, and that's frankly not sustainable because it burns a lot of cash, and given the current investment environment right now in the capital markets, there's not millions and millions of dollars of cash to burn. So number 3 and number 4 are very interrelated, but what we're seeing is a ramp down in crazy growth, focusing on this actually being a mature or maturing industry, and as a result, turning companies in this industry into, call it, cash break-even or actually profitable companies. And last one, batteries are finally going to be deployed because it makes economic sense, but only in Hawaii for now. Because of recent, because of net metering being taken away in Hawaii, batteries are going to start to make sense very quickly in that market, and they will be deployed actually for the reason that it's going to make economic sense, where in the past you didn't need batteries because the grid is your storage. Mainland is going to be probably a few years behind, depending on where rate structures end, call it in the next 2 to 3 to 4 years in major markets, and obviously depending on where the cost of a battery system goes. So these are my top 5, but anytime you want to look for trends in a market, one of my favorite places to look is Google. This is just a typical Google trend search, and it's probably a little bit hard for you guys to read in the back, but this is roughly a time period of 2008 to present. And this is a search for Go Solar in the Google web browser. And this isn't an aggregate up and down. This is based on, call it, other searches that are going on within a similar sphere in Google. They use an algorithm to come up with an indexed measure for how popular any search trend is. So what you'll see here is people that are Googling Go Solar, roughly around 20, call it 5 or 6 years ago, and it's bumped up to 30, 35, sometimes a little bit higher recently. Now, if you type into Google solar Tesla, you see an interest, and this is probably, call it in 2012, 2013, people who are buying Tesla cars and are thinking of going solar so they can power their Tesla cars, things like that. Then you see the sudden spike when the Powerwall was announced, and actually right now people are Googling solar Tesla just about as much as they are Googling Go Solar. But of course we all work in this industry. We think it's the most important thing in the world, but we have to keep things relative. So this is a Google search trend for President Trump. I don't know, I think personally we need to make solar great again, but that's just me. Okay, what's the agenda for the rest of this? We've got about 40 minutes to cover. And as I'm going through this, feel free to raise a hand and ask questions throughout, or save them to the end. That's totally fine. The more we can make this an open dialogue, the better. So let's start out with penetration. Where are we right now? So if you look at some of the biggest and most mature solar markets in the US, if you look at these blue bars, and again, it might be kind of hard for those in the back to see, so I'll try to spell this out. These blue bars are the number of single unit detached owner-occupied homes in key states in the US. So California, New York, New Jersey, Arizona, Mass, Colorado, and Hawaii. And if you look at California, there are almost 6 million of these homes that would ostensibly be suitable for solar. And of these almost 6 million homes, right now there are about roughly 400,000 residential solar systems. So even in one of the most mature markets, the largest market by far, we're still looking at penetration of roughly, call it 7%. Right now, net metering caps are, call it 3.5, 4 in the case of San Diego, maybe a little bit more than that, of the 5% cap, but that's likely going to be lifted here very soon. And this is just an example for me, that I like to look at, and being in this industry, it's very telling that there's so much space and so many roofs out there that we haven't even really scratched the surface. So looking at penetration or actually let's talk about the size of the market in terms of revenue. So this is a comparison that Ed and our CEO, Lynn, presented to some of our investors during Sunrun's IPO roadshow. And what it's meant to show is that relative to other very exciting industries that are attracting a lot of attention, residential solar is very, very, it's a huge market that's ripe and has a lot of revenue to capture from the incumbents. So right now, the US residential electricity sector, so if you add up every dollar that a homeowner spends on kilowatt hours in the US, it's about $175 billion, which is a huge number. If you look at some of these other comparable markets that are generating a lot of excitement, you see it in the press a lot, you see it as being a big focus in the tech sector. US hotels and motels that Airbnb is disrupting is about $140 billion. Uber, which is a company that is now worth about $50 or $60 billion, operates in the US taxi and limousine market, which is a $7 billion market. So the next time you're, called at a cocktail party and somebody's telling you about how much they like Uber and how excited they are about it, you can tell them, well, the market we work in is about 200 times larger than that in the US. So looking at this $175 billion, right now, the amount of money that homeowners are paying for residential solar in the US is less than 1% of that $175 billion. And as the market grows, so this yellow bar here is 2020, the EIA expects that homeowners will be paying about $208 billion, and homeowners in the US will be paying less than 5% of that for solar. So even as this market grows wildly, we're still hitting less than 5% penetration in 2020. And Ed had shown some version of this in his presentation. I think he was showing Bloomberg numbers. I'm going to be showing GTM Research numbers here. But this was GTM Research's expectations for market growth prior to the ITC being extended. So in 2016, we're looking at roughly 3,000 megawatts and growing to about 5,000 megawatts after a little bit of a dip in 2020. And this is after, let's go through. This is after the ITC extension. So what it does is it provides a lot more certainty and very, very steady growth. And these yellow bars, they might look kind of small by comparison or from far back in the room. But like I said, this is massive. This is 6 gigawatts of systems. This is 1 million systems and about $15 billion of systems that the ITC extension just created here. So let's talk a little bit about some of the largest markets outside of California. California typically takes up about 50% of all US residential solar deployments on a megawatt basis. New York is poised to be one of the fastest growing markets. So in 2016, it's a little under 250 megawatts. Going past 2018, it's going to be over 350 with an extremely steep growth curve. Part of that supported by the megawatt block incentive program there. Part of that is just due to the fact that it has some of the highest electricity prices in the country and also some of the highest, one of the largest total addressable markets. Massachusetts isn't too far behind it. The growth curve is a little bit less sharp, but it's a market that's been supported very heavily with incentives and generally receives a lot of state support. One of the things that could be happening in Massachusetts before too long is a replacement of their SREC 2 program, which is filling up very quickly with a New York style or California CSI style megawatt block or declining rebate system. Yet to be determined what that might look like exactly, but that's probably in the cards. New Jersey, not too far behind Massachusetts in terms of market size and growth trajectory. One exciting thing about New Jersey right now is its SREC program has hit its highest level in a few years now. I believe they're at about $270 or $280 after bottoming out at, I think it was less than 100 about a year and a half-ish ago. Arizona is, has typically been one of the largest markets, but industry researchers are forecasting fairly flat growth. Part of that is due to the fact that it's been a very strong solar city market. Solar cities had over 50% market share in Arizona for quite a while now, and partly due to regulatory risk there, and partly due to the fact that margins are relatively slim. They have scaled back quite a bit, and there's also a high degree of regulatory risk in that market just because APS is one of the most hostile utilities towards residential solar in the country. Maryland is a market that's been a kind of a surprise out of left field market lately. You're looking at installers like SolarCity and Vivint pretty much owning the market. Each of them has, call it 40–45% market share, and both of them have invested very highly or very strongly in Maryland, which has been the impetus for the growth here. And Connecticut is just another, call it similar to New York or Massachusetts, East Coast, high electricity price market that is seeing the same upward trend as some of the other larger markets in the area. Okay, so I've alluded to a couple bits and pieces around market share, but want to dive into the details a little bit more. So this is a chart that shows market share by installer on a national basis. So this is throughout the country. And I've only listed 4 bars here. And for those of you who can't see, the green bar is SolarCity, which went from 20% market share in the first part of 2013 to in Q3 2015, which is the last quarter for data, about 37% market share for residential installs. Vivint, which is the orange bar, has gone from 6% to about 11%, but their growth has actually ramped down quite dramatically. Part of that is due to the fact that they're dealing with some cash constraints and some issues around the SunEdison acquisition. This blue bar is the next 10 installers, so these are some of the larger national installers that aren't at the scale of SolarCity and Vivint. Companies in this would be, call it Sunrun's direct business, larger installers like Peterson Dean or Horizon Solar. I think Varengo would be mixing in there. And this has held pretty constant at about 11–12% for the past 2.5 years. And then this gray bar, this is the long tail. This is the part of the industry that many people here at this conference operate in every day. And just looking at this chart, it might feel a little bit disconcerting that a chunk of share has been captured. So it used to be that the long tail, smaller, local, regional installers was roughly 63% of the total market, and in Q3 of 2015, it was 40%. But while share has gone down a little bit, it's really not that impactful because everybody's still growing because the industry is growing so fast. So just in the past year, we've looked at 70% year-on-year growth from 320 megawatts in a quarter to 550. And what that means is for that gray bar, that long tail I showed before, is that it's gone from, in Q3 of last year, 114 megawatts to in Q3 of 2015, 222 megawatts. So that's exactly 100% year-on-year growth during that period. And we're really in a situation right now where rising tides are lifting all boats. And as somebody that works for Sunrun, I share the same opinion as Ed, who spoke earlier, that if you look at any home services business anywhere, there's always going to be a space for large national players, and then for regional, local installers that are relationship based and serve their communities more closely. Yep.
Are you going to later show the lease, as far as lease versus purchase data?
I do. I'll get to it. Yeah. So let's take a quick minute to go through a couple key markets. So who here mainly works in California? Okay, almost, let's call it 60% of the audience. And that makes sense, because if you look at the two biggest markets, PG&E and SCE, both of these markets combined represent about 1/3 of all residential installs nationally, by far the two biggest markets. And the breakdown in who's installing these megawatts is slightly different, but kind of the key style of the slices of the pie is the same. So if you look at PG&E, Solar City has about 40% market share, Vivint has about 10%, Sunrun has 5%. That's Sunrun's direct business, not including our channel installer partners. And then you have kind of a much smaller slivers of the pie for some installers like Peterson Dean, Sungevity, Solar Universe, the solar company, and so on. SCE is actually a market that's a little bit less consolidated than PG&E. It's a market with a larger presence of smaller installers. Solar City has about a quarter market share, Vivint has 9%. Verengo, which historically has been one of the larger players in SCE, has about 5%, and that's shrunk quite a bit in recent quarters. And then there's a mix of other companies like Horizon, Sunrun's direct channel, and so on. If you look at SDG&E, it's even less consolidated. So Solar City has about 22% of the market here, and then there's actually a high number 2 isn't Vivint for once. It's Baker Electric, then Sunrun, Sullivan, Vivint comes in behind, and then a smattering of smaller regional players. Arizona, I mentioned, is a market that's dominated by Solar City. They almost have 50% market share, with Vivint capturing about 12%. And SDG&E, despite being, call it about 1/3 the size of larger utilities like PG&E and SCE, is still about the same size as Arizona in terms of megawatts installed in any given period of time. So this is a listing of what the market share is by TPO, so third-party owned. These are residential PPAs and leases versus customer-owned, non-TPO. So this represents both cash systems that are bought outright and systems under loans. In California, this number has California used to be, call it about 65-70% leases and PPAs, and that's come down quite a bit in about the past year and a half, partly due to the fact that the cost of buying a solar system has come down. And we think it's probably going to be staying at this level, call it 50-50, and that's part of the reasons why Sunrun we've launched our own loan product, and we're seeing a good bit of adoption through that of that product set for us. There are some other markets where you see differing market shares for lease and PPA products. Arizona, New Jersey, for example, is almost entirely leases and PPAs, though a big part of that is just due to the penetration of larger lease and PPA providers in those markets. Colorado has typically been a cash market. Massachusetts is about 70% TPO. New York is kind of similar to California. Nevada, which I have not shown here, is somewhat similar to Arizona. Historically, it's been about 90% PPAs and leases. Yeah.
Do you know what's the share of the 47% that went to loans?
Yeah, I don't have a exact figure offhand, just based on our own numbers and what we've seen in the market. I'd say it's probably about, call it 60 to 70% loan financing, with the remainder being cash. It might differ from market to market a little bit, but that's generally been our impression. As far as who the loan providers are and who's been offering the most loan products, this is data through a company called Energy Sage, which is not necessarily reflective of the entire market, but is probably the best represented example of who the biggest loan providers in the residential solar market are. The biggest one by a pretty far degree has been Admirals Bank. A big reason for that is it's been one of the preferred lenders through SunPower's dealer network. SunGage, which has a pretty large presence, particularly on the East Coast. They're based out of Massachusetts, comes in number 2. And then there's a longer tail of players like Interbank, Green Sky, Eastern Bank, Dividend Solar, which is an upstart San Francisco company, coming in, and then Hero through its PACE program coming in about 2% at the bottom. Yeah.
I have a differentiation problem between using third-party owned and loans as the same perspective. For example, in Massachusetts, we just came out with a loan program specifically designed by the state to stop leasing the Linder because they recognize that with leasing, none of the money stays in the state. But even though it's a loan, the customer still owns the system. It's not just because it's third-party owned doesn't mean it's a loan or the interest, right? Just start trying to make that distinction. When you talk about third-party owned and loaned, it seems like you're talking about the same thing.
Yeah. So I apologize if that was the case. I completely recognize that you have, 2 different segments of the market. You have third-party owned systems owned by companies like Sunrun, SolarCity, Vivint, and you have customer-owned. And within those customer-owned systems, customers can have the choice of taking out a loan to finance it, or if they have the capital, they can just buy it outright. It very much depends on the profile of the customer, and it depends on the relationship with the installer that they work with. Some products are better for different people. I think it's important to have different products in the market so that people can work with what's best for them. Yeah.
Are the training modules going to be available to us after the show?
I don't think Hannah's in the room right now, but I'll send this on to her, and I think she can distribute it to the... Yeah, absolutely. Okay, so I just want to close things out by talking about some trends in pricing and costs in the market. And let's start with average capacity-weighted system prices by market. This isn't Sunrun data. This is data through a third-party research shop called GTM Research. I'm sure most of you are familiar with them. And what they're reporting is that there's a pretty wide band in system prices on a dollar per watt basis. But since 2012, it's come down from about $580 per watt to a median weighted number of $450 per watt, which is, to me, seems a little bit high compared to what we've seen in the market. But that could be skewed by the sources of their data. There is a pretty wide range, so I'm not sure who the person is that in 2014 bought a system for $9 a watt, but they must have had a very good salesperson on the other end. And then you have people that apparently are buying a system for $2 a watt. So there's a wide range. I tend to think that these numbers are actually a little bit high, but they're the best publicly available figures that we can put out there. Yeah.
Well, I remember last year Lind was presenting the same data, and it was like 365 a watt was the average. Just so you're probably correct that this is higher because a year ago, I remember specifically that her average number was 365.
Yeah.
Capacity weighted mean? Is there something else taken into account?
Yeah, so I don't want to speak for the research providers that put this data out here, but I believe this is saying, okay, if you have a lot of systems that are priced at $5 a watt, call it, being reported into this data set, then they receive more weight on average than kind of smaller systems priced at a different level. So, if you have a large system priced at $4 a watt and a small system priced at $6 a watt, then the capacity weighted average will be closer to that $4 a watt. Yeah.
As far as the cost basis, I know it's a completely different thing, but could that skew the number as far as the cost basis for leases and PPA?
Yeah, that might be the case in this, is that the providers are looking at fair market value approaches to evaluating systems being reported in public data sets.
What is that? And just out of curiosity, how much do you see that differentiation?
There's a range. I probably can't give you a specific number right now, but can look into it. But there is a delta where TPO systems will typically have a higher reported price within public data sets as opposed to cache systems. And there are, part of the reason is that there's a different approach for evaluating for tax purposes the fair market value of TPO-owned systems.
Do you know if this includes commercial and industrial?
No, this is residential only. Yeah. Okay, so those are prices to end consumers. These are probably more closely aligned numbers to what the people in this room typically think of when it comes to cost. If you look at what GTM Research has put out there into the market, they're saying that if you add up all the system costs associated with the system, so all the direct costs, the sales cost, the overhead margin, you're looking at about $3.50 a watt cost to the installer. And if you look at some publicly available comps for system costs out there, currently the market leader is Solar City. Now there's some commercial being included in this, which typically brings your average system cost down a little bit. But they're looking at an install cost of $192, sales cost of 64 cents, and a G&A, which is overhead, at 27 cents. Vivint is not far behind them with it, total cost of, call it about $310, $315. Of that, install is about $227. Sales is 59 cents, and overhead is 26 cents. Sunrun's cost, which I haven't put in here, is a bit higher than this. I think Ed showed our numbers earlier this morning, but that's mainly due to the fact that when Sunrun purchases a system from our partners, our installer partners, that's typically a fully baked cost, which brings our average cost per watt up a little bit.
Stephan, I stand corrected. That's where the last year, see, that was at 365.
Yeah.
That's like.
It's probably a difference between customer-facing price and system
So
cost.
as of last year, it's gone down from 365 to 350, which totally makes sense.
Yeah. Yeah.
If you could clarify the categories. On install, that's not just labor, that's materials?
Yeah, so install includes...
Materials and labor.
Exactly, yeah.
So what's S&M, sales and marketing?
Yeah, so those are sales... G&A is all overhead, so, say the, executive salary, it's the, the Exactly, yeah.
Profit margin out there. That's not the fund. That's not the cost to the customers. That's the cost to the...
Yes, this is just the cost to the businesses themselves. There's no reflection or amount of revenue that they bring in. This is simply the cost side. Any other questions? I feel like this is a one of the more question-generating slides here. Anybody else?
What, do you have an idea of what's the margin that companies are?
Yeah, so for these publicly available companies, margin is a little bit of a difficult thing to build out because these are essentially project finance companies that have revenue coming in over the course of 20 or 30 years as opposed to gross margin companies that typically, they sell at X, their cost is Y, and their profit is the difference between the two. I will say for Solar City, if you look at, for example, its typical California cash system, then it prices those at $5.10 a watt. So if you just do some basic math, that's about $2 a watt in margin. That said, they don't sell too many cash systems. I think my next slide actually goes into margin a little bit. Yeah. So if you look at GTM Research's modeled cost, 355.
Yeah, go back one more. Go back. There you go. So it's 422 or 450. It looks like the cost on the bid is 350.
Yeah, I was wondering what solar cities they charge, because I know they've been charging
$5.10 a watt.
plus.
Yeah. So, last slide of the day. This is a breakout of the different cost components that are going into a residential solar system. And again, this is just through GTM Research. This isn't our own data. This isn't SolarCity's data. This is just a third-party data provider that's offering this. But I know it's probably a little bit hard to read for those of you farther back in the room, but the short story of this is that direct or hard costs, which is all of the equipment that goes into systems, the modules, the inverters, the balance of plant, that's come down about 14% year on year. Partly just due to the fact that system prices have come down. Soft costs, which are things like labor, engineering, and so on, that's come up about 14%. And as a result, total system costs have pretty much stayed about flat at about, call it 350, 355. So that's it for this segment. Any last questions? Yeah.
You talked about the system costs coming down, trying to target the 225 a watt.
Yeah.
What do you see in those bars that have the best opportunity? And I guess do you see that the railless racking system is one of those major targets, or is it just other things?
Yeah. So I think you hinted at one important thing in particular. When you look at SolarCity's 225 a watt cost target, there's a lot that goes into that. A major factor is the fact that they, being the largest player in the market, can get very good deals on equipment. Part of it due to the fact that their scale and their platform and their software allows for very efficient deployment of install crews, which means that they can set up installs in which they look in advance at where customers' homes are, know that they're going to be installing two similar homes in a similar time period on the same day, and then we'll deploy a truck to install two systems in one day and minimize drive time in between the two to 10 minutes. And that effectively allows for the same install crew to do, call it twice the number of systems than if they had to do one on one side of town and one across from town. So when you add up equipment, efficiency due to scale, and also the fact that they are really ramping down their growth from about 80%, 90% year on year to about 40%. And as a result of that ramp down, that means that they're going to be entering less markets, spending less on new branches, spending less money on ramping up sales teams as fast as they have lately. And those are fixed costs that have typically been applied to a very large base of deployments. And you ramp down those fixed costs while you more slowly ramp up deployments, and ultimately you can bring your total installed costs down. Another key thing that they've been doing, and I think the industry is focusing on as it's moving towards smarter growth rather than crazy 80, 100% year-on-year growth, is focusing on the most efficient sales channels. So referrals, for example, and word of mouth are by far the lowest cost way to bring in new customers. SolarCity's said publicly that their mix is about 30, 35%. But as you think of a market and you think of scale in companies that have been in the industry for a long time, as you're spending less money on third-party leads, customer acquisition, through retail channels and things like that, then you can, all else equal, bring up your referral mix and bring down your acquisition marketing mix, and that brings your sales cost down significantly, over the course of several quarters. Yeah, I mean, one of the single biggest ways that smaller installers and regional installers that have had a presence in a given market and community involvement for a long time can beat some larger players like, call it Solar City, on a cost basis, is just the fact that Solar City, other large installers that are expanding very rapidly, spend a lot of money acquiring customers. That's buying customers or buying leads from companies like CEE and other lead generators. It comes from staffing people in Home Depots. Which is very expensive. It comes from, trying to acquire customers from from a very diverse base, which is much more expensive than, call it, somebody having a great system installed on the roof, really loving the experience, and then turning around and saying to his friend, hey, you should go solar with this company. Yeah.
Do you have any figures of man hours per watt for installation?
Not off the top of my head, no.
The question is, like, you said that batteries in Hawaii are going to make economical sense. Are you saying that customers will be able to purchase batteries and still get the kilowatt hour price to be lower than what they pay to the utility company?
Yeah, so Hawaii is a really weird market, but its weirdness is, I think, going to enable the fact that batteries are going to make sense in 2016. It has the highest electricity prices in the country, despite the fact that oil prices are so down. It's still running at 35, 40, 45 cents a kilowatt hour, which is huge, and you have homeowners spending $700, $800, $1,000 a month just on their electricity payments, and these people aren't living in mansions either. So solar has taken off as a result of that. Right now, penetration in Hawaii in terms of single-family homes is something on the order of, call it 12 to 15%, depending on what metric you look at. And as a result of that penetration, the utility there, HECO, has brought in they've essentially gotten rid of net metering. So net metering doesn't exist right now. Right now, customers can get 15 cents for exported power, but I believe there's a certain cap to how many customers can get that 15 cents before we simply are forced into a self-supply tariff, which means that our policy team can speak a little bit more into the specifics and details of this, but for exported power, there's little to no value associated with that exported power, but if you have a battery and you can capture that power and then discharge it during the night, then you can offset 40-cent electricity. So batteries don't make very much sense if you're offsetting, call it 15-cent electricity, but if you're offsetting 40-cent electricity, then that's where the needle starts to turn to the other direction, and batteries will make economic sense in Hawaii. We have a team that's looking into it right now. I don't know exactly what the threshold is. There's a lot of math that goes into it, but when you are looking at 35, 40, 42 cent electricity, then it starts to make sense, yeah. Anybody else? No? All right, well, thanks so much for your time, and enjoy the conference in San Diego.